Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Tuesday, September 21st, 2021, and I'm pre-recording this Trading Places Live just a little bit earlier. This will air when you get this. It'll be 9 a.m. Eastern, so we're just doing it a little bit early this morning. Currently, futures are looking like we're going to rebound a bit, at least to get started on the day. Currently, Dow futures up about 285 points. S&P 500 futures up 33 and a quarter. NASDAQ futures up a little over 100 points. So on a relative basis, looks like the Dow Jones will get off to a little bit better start than the others. Crude oil prices up about 1.25% this morning. The 10-year Treasury yield last check was down, or excuse me, actually is up a couple of basis points to about 1.33%. So that's the early action. Of course, it was a rough day on Monday. We're going to get into all of that in just a minute. Today's agenda, we will start off with that daily market recap, then talking technically, sector analysis, earnings spotlight, and we'll wrap up with the three you must see. First, however, let me take you over to Earnings Beats. Those of you who are new, if you come over to earningsbeats.com, you can sign up. We have a no-cost 30-day trial to our full service. But if you just want to check us out for a period of time, I understand. You can scroll down and you'll see on the left-hand side of the page an area where you can sign up for our free Earnings Beats Digest newsletter. Simply type in your name, email address, hit that subscribe button. This is a 3 times a week free newsletter, Mondays, Wednesdays, and Fridays. We'll get it out to you usually by about 8:30 in the morning, about an hour before the market opens. There's no credit card required, and you can unsubscribe at any time. So we'd love to have you join our community, check us out, and get to know us a little bit and the things that we look at when we're approaching the market. We have a unique strategy at earningsbeats.com. My background is in public accounting from many years ago. So we look at the fundamentals. Obviously, we also look at the technicals, and we throw in a third area of the market, which is the historical analysis. And if you saw the market on Monday, I was warning all last week, we are in the second worst week of the year historically, dating back to 1950 on the S&P 500. So, and I talk about that every once in a while in our free newsletter. So if you're interested in taking that 3-pronged approach, fundamentals, technicals, and seasonality, historical performance, I think you'll enjoy not only our free newsletter, but our service. So check us out. All right, let's move on to the daily market recap. It was an ugly day. We did recover some of the losses in the afternoon, which was good. But still, you can see the Dow Jones Industrial Average down 614 points. The S&P 500 down 1.7%. That's 75 points. NASDAQ down 330 points. That was over 2%. So on a relative basis, NASDAQ hit the hardest. Mid caps down 43 points, which was about 1.6%. And then small caps down 26 points, which was just a tad shy of 2%. On the major indices, I thought the small caps, I mean, if you look at cross over the last 6 months, 1275 to 1300 has been a pretty big area of support. We went into that zone before coming back up and closing just over 1300. So I thought that was interesting. Also, the Dow Jones, you can look back over the last few months, 3 to 5 months, and see bottoms have formed in this 33,500 to 34,000 area. Again, we got down into this zone, and then we were able to come back up, closing pretty close to the top of that zone, back up near 34,000. So a recovery. It wasn't as bad as it could have been, and the market certainly was bad. It was a rough day, but it could have been worse. And thankfully, we did get some buying coming in later in the day. Now with futures up this morning, it looks like we'll get even more of those losses back, which is good here. Energy, the worst performer on Monday. We had energy down over 3%, financials down 2.75%, discretionary 2.25%, communication services down 2%, materials down just shy of 2%. So across the board, pretty rough. Materials, the one I think testing the biggest area of support you can see going down and hitting that low that we saw all the way back in July. We did bounce off of it, so that's good news. Short term, I would say materials, probably not a bad short-term trade on the long side because you can manage your risk. Anything down below this double bottom, and I would be out of the XLB. So look for a little bounce in that area of the market. 10-year Treasury yield. Let's get a quick update. I don't think, it's not showing here on this chart yet, but I did see that we were up about, maybe just shy of 2 basis points, back up near 132, 133. We're in this range. We've got to get through 140 to the upside. Until we do that, I would say we're just range bound. 113, 114 to the low, up to almost 140 to the high. That's the range that I would continue to follow. Now, short term, you might even look at this trend line, see if this holds. But I'm just looking off these recent lows. So right here, I'm not putting a whole lot of stock, no pun intended, but not putting a whole lot of stock in this trend line right here. It's very short term, only a couple of trend line tests. I'd be much more concerned with holding on to this support area. So you can look at the opens and closes at around 116. You can go down to these lows at about 113, whatever, your style or your strategy is. I'm just going to say this whole range right in here. I mean, you can see the top here, the top here, we broke out. Now we've gone back down. We've tested this area, put in these lows. I'm going to say 113 up to about 120 on the 10-year Treasury yield. Pretty good area of support. Break below that would not be good for financials. Financials tend to be very positively correlated, at least their relative performance relative to the S&P tends to be very positively correlated to the direction of the 10-year Treasury yield. So as the yield comes down, you can see financials relative to the S&P coming down. When we were trending up in the yield earlier in 2021 and even the latter part of 2020, we saw financials on a relative basis going up. So the yield has a pretty big impact on this area and the financials, especially the banks, life insurance companies. Those would be a couple to watch very closely, but a breakout above 140, and I think that would bode very well for banks. So keep an eye on that. Only one economic report out today to really influence the 10-year Treasury yield: August housing starts and building permits. So that'll be out later this morning. Housing starts in July was 1,534,000. In August, we're expecting them to move up a couple percent to about 1,575,000. Building permits, on the other hand, were 1,630,000 units in July, and we're actually expecting a little bit of a drop there to 1,610,000 units. So that'll be out later this morning. That will certainly have an impact on the bond market and potentially on the stock market, more specifically those housing stocks. But also the Fed meets starting today. And so the announcement will be out tomorrow. I think that's what the market's really going to begin to focus on here over the next couple of days. All I can say is the Fed tends to support the stock market. I would not be looking for the Fed to drop any bombs on the stock market. That would be quite unusual. I think they'll continue to support the market. So my guess is that once we get through this week, get the Fed behind us, I think the market's going to be set up to go back higher again into the fourth quarter. We'll see. All right, let's move on to talking technically. With all the weakness yesterday, I just want to bring up a chart that I like to bring up frequently, just as a reminder to everyone what we're in right now, which is a secular bull market. That is not up for debate. We are in a secular bull market. Lots of folks constantly trying to call bear market. It's not a bear market. In my opinion, we're nowhere near a bear market in terms of secular. I'm talking long term. Look at what a secular bear market looks like. Secular bear market lasts 13 years. You can see it back in the late 60s through the early 80s. You can see it in the 2000s into 2013, which is when I believe the secular bull market was officially launched. You can look all the way back into the 1930s, 1940s. I mean, we go through very lengthy periods where we can't set a new high. I don't think there's any question over the last 8 years, 9 years, that we are setting new highs consistently through the trade war, through the pandemic. Here we are, still just a couple of weeks removed from having set a new all-time high. We are in a secular bull market. Treat it as a secular bull market. We're going to pull back from time to time. That's inevitable. That doesn't make it a bear market. Consistently look at this as a bull market. Use these pullbacks as opportunities. We don't get them very often. And then everyone's afraid to buy because we're overbought. Okay, well, this is helping to relieve those overbought conditions. We should be welcoming this. It's September. We know September is weak historically. So I think this is an opportunity. One thing on this monthly chart that I think is really interesting is it's a monthly chart. I want you to look at the PPO, the monthly PPO. The only times we see the monthly PPO go negative is during a secular bear market. It's because in a secular bull market, we never see weakness long enough for a monthly PPO to go negative. Here was the 1987 crash. The PPO went from 12 down to about 2, but it stayed positive. Here was the pandemic. I mean, we barely even budged to the downside on the PPO. Maybe we went from 5 to 3. It's because it doesn't last long. So that downward momentum in the monthly PPO barely budges. But it's different when you get into a secular bear market. So anyhow, just keep that in mind. The other thing I want to talk about here in talking technically is gold. When we do start to see the market weaken and the volatility index pick up, gold tends to do well. And yesterday, when the market was down, gold was one of the few areas of the market where you could actually have made money on the long side. So gold bounced. But technically, I don't like it. I mean, we've been in a market that's been going higher and higher, and yet gold, reached 1960 a couple of times back at the end of 2020, and then also beginning of 2021, got back to 1920 in June. I mean, we're sitting down here at 1763 right now. So yeah, we were up $12 an ounce yesterday, but 1763, we're still way off those earlier highs. And the more telling sign is when we start looking at a relative chart. So here's gold versus the S&P 500. So here is the downtrend that we have now been in on a relative basis for a year and a half. And notice this is a 5-year chart. We just went to a new 5-year low, gold versus the S&P 500. So if you think gold is a good investment, I would ask you to come back and check out this chart, because these relative charts don't lie. I mean, you could put your money in the spider. If you put your money in gold instead, this is how badly you're underperforming that spider. If you just put it in the SPY, which tracks the S&P 500, you'd be much better off. The periods when you actually see gold do well is typically when we're seeing fear build. So if you look back to the end of 2018, the trade war, we had gold outperforming. Look at the VIX. The VIX went from 12 to 30. In February to March, of course, this was the pandemic. Gold, huge outperformance. Look what the VIX did. The VIX went from 15 to 65. Gold tends to do better than the S&P 500 when there's a lot of fear. So once the fear starts building, I mean, if you wanted to take a position in gold, I think you will outperform. But when that fear ends and starts coming back down, your timing has to be very solid, because gold will give it up. Now, the other thing I find very interesting with gold is that normally gold does well when the dollar is weak. Well, the dollar down here at the bottom peaked in March of last year and went down for a solid year and has now just been going sideways. But during that year, the VIX going down, dollar going down, gold was going down relative to the S&P. So even with the dollar weakening, which should provide tailwinds for gold, even with the dollar weakening, gold could not perform well. So if you can't make money in gold on a relative basis, when the fear is spiking, which it's been doing now for the last few weeks, if you can't find, an opportunity in gold when the VIX is spiking and when the dollar has been weak, when are we going to see it outperform? We're going to just keep hoping? I don't think that's a very good strategy. So just be careful with gold, and especially, with the dollar. Watch the dollar, because I believe the dollar is starting to strengthen again. And if that's the case, I really don't think gold's going to be a very good investment. Just my opinion. Do what you feel is comfortable, but just my opinion. Last thing I wanted to point out about this chart, I put in here this correlation. Let me make it a little bit bigger so you can see this here. So this correlation right here in this panel, this is the correlation between gold, gold's relative strength versus the S&P 500 and the VIX. So in other words, gold versus the S&P 500 is positively correlated with the VIX, meaning that when the VIX goes up, gold tends to outperform the S&P. When the VIX goes down, fear dissipates, gold tends to underperform. And that's shown here simply by using the correlation coefficient, which is another cool indicator here at StockCharts. So just keep this chart in mind. When the volatility index is rising, you have a much better chance with gold, and that's what the correlation's telling us. But when the VIX is going down, the correlation's also telling us you don't want to be in gold. All right, let's move on to sector analysis. So I wanted to just talk a little bit about, the key sectors, not just on an absolute basis, but on a relative basis. So you've got the XLK technology. It's been, performing extremely well. We've had almost no pullbacks. I want you just to look back February, March, April, May. You see these very big moves lower. Even go back into October of 2020, the big move lower, lost the moving averages, lost the moving averages, lost the moving averages. Well, here we are moving back down, losing the moving average. Now, I want you to tell me how bad things got after we did that the last 3 times. I mean, we rallied right back. So I think there's a couple of things you have to realize with these groups. It's not so much their absolute performance. It's more, to me, it's more about their relative performance. And when I look at the XLK relative to the S&P 500, I see almost no pullback. So look at this again. You've got, for the last 3 weeks, we've been moving lower on the XLK. Very similar to, back in February and March, and then also April and May. But when you're looking here, you see almost no deterioration. In other words, technology is going down just because the overall market's going down. It's just dragging technology with it. Technology is not leading this move to the downside. And if you look back to February into March and April into May, do you see the difference? Technology was driving to the downside. Growth stocks were driving the market lower. The market's coming down. This is just normal profit taking. We're not seeing anything out of the ordinary, especially in terms of growth stocks. If the market rebounds and we see technology break out, I think that would be an incredibly bullish signal. So keep an eye on that. Let's keep watching for that performance in technology and how we perform going forward, not just on an absolute basis, but also on a relative basis. All right, then we've got consumer discretionary. Now, consumer discretionary, we've talked about this. 185 was resistance. We went right up there. We have not been able to close above 185. So I think the sideways consolidation period remains in play here. 175 is the short-term support level. And I would say in this pattern of higher highs, higher lows, higher highs, higher lows, the real big level is 165. But I don't see us going back down there. Just keep that in mind, though, if the market were to weaken. We've got room to the downside before you start seeing lower lows printing. And that is what would start to make me think, okay, we've got ourselves more problems when we start downtrending. We're still in an uptrend. And very good support short term at 175. So I'm not really seeing anything on the XLY. Now let's move over take a look on the relative chart. Consumer discretionary, not nearly as strong as technology. And it's not so much discretionary stocks, it's all consumer stocks. I want to show you consumer staples, the other part of consumer. Look at what consumer staples on a relative basis has been doing. So we're not going to get the full force of the consumer until we, I think, get COVID, the Delta variant, behind us. And I don't know when that's going to be. I don't think anybody knows when that's going to be, but I think that's impacting some of the performance of consumer stocks. I mean, if you look, we had a beautiful recovery. Looked like things were great. We got the vaccine news in November, I think it was, the positive vaccine news. And then in February, we had the Delta variant begin to emerge, and you can see that it's had this second wave, if you will, impact on consumer discretionary on a relative basis. Now, again, if we look at the absolute chart, we're fine. We haven't broken down, but we're not performing as well as the S&P 500. So I'd like to see this break above the 20-day hold here and see consumer discretionary start to move into the fourth quarter. That would be best. The last one I want to show you, and these are the three aggressive, well, there are 5 aggressive sectors, but the 3 that I like to watch closest are technology, consumer discretionary, and communication services. So here's communication services. We've seen almost no weakness in communication services. So this has been a little bit more unusual here with the selling the last couple of days, Friday of last week, and then again yesterday. So XLC breaking down below the 20-day. For the first time, it looks like we're going to go into negative territory. I mean, I guess maybe back in January of 2021, looked like we went negative very briefly and then back up again. Also beginning in November, but it's been a long time. But this has been one of the better areas of the market. So, as I look back to some key areas, I'm going to maybe look for the XLC. And I don't know if we're going down there. I'm just going to maybe the last big sell-off we had was probably this 5-day sell-off right here back in mid-July. So I'm going to look for maybe 79.25 or so to provide some pretty good support. We got to a low of 80 and change, but I think we could go down another $1 or so from that low if the market were to accelerate with selling later this week. So that's something to keep an eye on. Now that's your absolute look. Let's take a look at the relative look. Whoops, wrong one. Let's go back to communication services. So communication services, I think overall has been handling the pandemic pretty well. We've gone through a few periods. Here was December into January, and then again in March, where we had some pretty big moves lower. You can even look back to August through the beginning of October. But overall, I think if you just look at this, you see an uptrend. And I expect that's going to continue through the fourth quarter. But do we hold this 20-week EMA, this relative week EMA? I don't know. I think this will be a question we're going to have answered here over the next week or two. But I do believe the 50 holds, and I do believe this uptrend, overall uptrend, remains intact. And I fully expect heading into the fourth quarter, we're going to see another move to the upside and relative strength here. All right, let's move on to earnings spotlight. So I just wanted to point out first, Lennar. They reported last night, really the only significant report that we had yesterday. They did beat on their bottom line, $3.27 versus $3.24. However, they had a pretty big miss on their revenues. Revenues were expected to come in at $7.27 billion. They came in at $6.9 billion. So a big miss on the revenues, even though they did beat on the bottom line. Lennar pre-market, last time I looked, down about 2 1/3%, which would take it down to, well, probably down about 2 1/4, which would be close to $96. So still above these areas. I would be watching maybe this 91 level. I think that's a major support level. Here we got a new high because you got the higher high, higher low, higher high, higher low, and equal high. I'd like to have gotten through 110, didn't make it, double top, and now moving back down. I think the 90, 91 area could come into play here on Lennar. Other companies reporting later this week. Adobe will be reporting. Actually, I think maybe FedEx might have reported. They usually report in the, I don't remember if they report in the morning or not, but let's see if, I did not see the report. If they did report. Stock up over $2, but market's up. So I'm not sure if that's earnings related or not. But anyway, FedEx reports today. We've got AutoZone reporting today, Stitch Fix, Wednesday, General Mills, BlackBerry, KB Homes. Thursday is a pretty big day. We got Nike, Accenture, Costco, Darden Restaurants. So we got some big names later in the week, but it's still overall pretty quiet week. All right, let's go ahead and wrap this thing up. I'm going to give you a little bonus today. So instead of the 3 you must see, I've got 5 stocks I'm going to try to go through here and show you. So well, before I even get into that, what I did is I ran a scan. I don't want to change the screen. Let me go into the dashboard. I want to show you what I did. So one of the cool things about StockCharts is you can go into the scans and click on this little button for more, hit predefined scans, and then scroll down. And when you get a big reversal on the market like you did yesterday, I look for hammers. And so I pulled up the New York Stock Exchange, these 71. I took out the ETFs and any funds that appeared. And then I put the rest of them. This is it. There are 50 of them. And I did a candle glance chart just to quickly look to see if any of them are at or near a key support level. And so first one that I noticed was the Bank of Nova Scotia right here. I looked across here and I was like, oh, $60 looks like a pretty good level. We could put a hammer right on it. So when you're looking at these charts, I'm going to go through these hammers. I'm not going to annotate all of them, but I do want to just kind of show you. Here was the prior high. Here was the breakout. We went back, tested the level in April, tested the level again in July, and now here we are putting a hammer in. Looked like we were breaking down intraday. This could be, this could be a very significant bottom for the Bank of Nova Scotia. And if it does go back down below today's low, you just simply get out. So if you're looking for a trading idea, I think this is one. Certainly, it's a bank. It's not, going to be a high octane, high volatility type of trade. But Bank of Nova Scotia certainly looks like it could bounce from here. Others on this scan, I'll just go through them pretty quickly. Diebold, been downtrending for a while. You can see with heavy volume, the low that was in here about 9.5. We tested it, put in a hammer yesterday. That's an interesting one. How about EQH? This is Equitable Holdings, putting in a hammer off of a downtrend right where we had that prior low in July. Also, the breakout area was right at about this level as well. So EQH looks interesting. FINV, Finvolution, came down, gap down, put in a hollow candle mid-August. Well, we went down and we tested that level. We're in this major gap support area, printed a hammer. And then the last one I have for you is RY, which is Royal Bank of Canada, another bank. You can see that support level from July at 97.5. Went down below it intraday, but we recovered. So banks, and there were a number of them on this list. So I think banks are an area you might want to consider for a short-term little trading opportunity here. All right. I think that's it for today. Appreciate everybody stopping by. Make sure you tune in tomorrow morning. I'll be over at Earnings Beats. All you do is you go over to Earnings Beats and click on Trading Places Live. We'll start at 9 a.m. And once you get in, there will actually be a spot where you can click to join the room live. So love to have you. Come on over tomorrow morning, 9 a.m. Eastern at Earnings Beats. Will be your next Trading Places Live. Have a great Tuesday, everybody. Happy trading.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.